Hello, viewers. My name is Sunday, and I welcome you all to this episode. All right, if you are new, please do subscribe. Just hit the subscribe button, activate the bell sign, and every other thing will just be history. Okay, because it's very important for you to subscribe because these resources I'm just giving out is for free. And if you have been following us since the beginning of this month, as we are um, doing this 1 month crash course for beginners who are interested knowing how to trade, I will say congratulations because I know by now you should be doing something for yourself because after all um, the course that all the materials that I put together, and I'm just offloading it, giving it to you guys for free. Uh, it's an opportunity, and I want you guys to embrace it. Don't take it for granted, all right? Don't take it for granted because this is what you pay for. This is what you go to another place and you pay for it. It's the same thing I'm giving you. I'm even giving you the way I'm even teaching it. I explain everything in a very slow manner, all right, in a very slow and very uh in the simplest form. Let me put it that way. That being said, please, you can also visit our website, againstfx.com. You see all the materials that are there. We also offer mentorship if you want to trade, keep trading with us. All right. Because if we train you, we will not just let you go. You'll be in our community, we trade together. All right. Because in Forex, there are so much to make. All right. And my YouTube name is Against FX. All right. So today's topic, without wasting time, all right, without wasting time, we need to just dive straight to the topic of the day. And before we proceed, if you have any comment, please leave it at the comment section. Those who have been following me since we started this 1 month course, 1 month crash course, please, I want to be seeing your comments. All right, your challenges and your improvement. What's uh, the topics that you have already treated yourself because everything is in there for you as a material. So you select each videos, watch topic by topic, and you understand everything. So that being said, if you have any comments, please leave it at the comment section. And if you are facing any challenge as regards to trading, all right, please let me know. All right. So that being said, today's topic is what? Trade management. Trade management. All right. There's difference between risk management, all right, and a trade management. All right. The risk management is when before you get into taking a trade, you have to properly um, put your things together, your checklist, what you have to do, the price at which you want to get into, the market where you are going to put your stop loss and your target, your TP, or when I say TP, I mean take profit, where you're going to put your take profit order, all these things, and the type of the size of your lot, as in your lot size that you are planning to use, and the risk per trade. All these things are embedded in risk management. All right, all those things before you even take, as you are planning to get into the trade, all those things you have to plan. All right. So the risk management takes care of what? The planning, the pre-planning before you step in. Now, after that, there is what we call trade management. You have already planned your risk, how you want to enter the price and all that, how you want to get out, and your lot size and all that. You have already defined all that. Then, after you now press buy or sell, you do your settings, take profit, stop loss, and all that. Then the next thing is that there's what we call trade management. Trade management will now take it from there. After you have entered or rather get involved in the market, then you have to now perform what we call trade management. You have to now uh, outline the way you now want to manage your trade as it progresses, all right? You don't just click enter, get involved in the trade, set your stop loss, your take profit, and just allow it like that. If you hit your take profit, let it hit. If you hit your stop loss, there's what we call set and forget. All right, but there is still need for trade management. Some people, what they do, once they just enter the market, they just close their system, leave it. If anywhere, if we hit their take profit, is okay by them. If it hits their stop loss, is okay by them. They wait for another setup. That is what we call set and forget. So you don't need trade management, but you need to manage your trade. Why? Because trade management will now take care of after you have entered the market, the way you will now manage your trade. Let's say, for example, I'm going to show you some few slides in a moment, but just sit back, relax, get a pen and a paper so that you can take notes. It's very important. You don't just watch the video and think everything will just store in your head. It's not possible because we have everyday challenges. All right, before you know it, the thing will just evaporate. It will go off. You watch it, you think you've known it. Before you know it, as you leave, as you close your system, the thing will evaporate. You will not even remember anything. So it's always good to take notes, all right? So that you can always open your note and refresh your memory. It's very important. So as I was saying, the trade management is you get into the trade, then you now start nurturing that trade. All right? Once you see that is going in your favor, there's a way you can nurture that trade. All right? You can set what we call trailing stop, all right, to help you book profits. Or if you don't want to use a trailing stop, you can take partials yourself. You just, once you get to some level, you take partials. How do you take partials? Maybe you are using one lot size. Then you are now in profit. It will now get to a certain level. You have made some profit. You now reduce that 1% of your asset, you reduce it to 0.5. All right? We reduce the lot size to 0.5. All right? Once you do that, if you are bullish, that means you have already sold half of it. So you now leave half to keep running. So you book partial profit. All right. In some cases, you might just move your stop loss. Once the trade is going in your favor, you just move your stop loss up to, you just start adjusting your stop loss a little. And once it start going, then you now move your stop loss into break even. Simply means even if the trade now decide to reverse, if it hits that level, you are not losing anything. You are not risking anything. But at the time you enter, when you set your stop loss, maybe if it is 20 or 30 pips, you are risking some money based on the asset pip movement, the cost of one pip. All right. Price interest point, that is what we call pip. All right. So by the time you now see that you are in profit, you manually move your stop loss into break even, meaning that you move your stop loss into where you entered the trade, your entry price. All right. And if you want to even save, maybe you want to just immediately book some, you can just move your stop loss a little above your entry price. All right. So those are the ways you can manage your trade uh, manually. All right. So that being said, let's just go and let's take a look at some slides so that you understand what we are saying. So one good thing about uh, trade management is that you can use what we call trailing stop. All right. That is one thing that you can use to manage your trade when you are not there. All right. Because a trade management simply means that, okay, you have placed your trade, the way you now nurture it as a trade progresses. All right. It's very simple. How you now manage your trade after you get involved in the market. So one of it is using a trailing stop. A trailing stop is a dynamic stop loss that moves with the price. Do you understand? A trailing stop. Now, there's what we call stop loss. That one is static. All right. Your entry price, your stop loss that will prevent your capital from any loss, from further loss. All right. Now, that one is static. Then we'll have trailing stop, which is dynamic. All right. That one, once you activate it, it will start moving based on the type of the settings, or rather what you want the trailing stop to do. It's either by pips, by percentage, and others. So you will see everything in a moment. So right now, one moment. Okay. A trailing stop is a dynamic stop loss that moves with the price. Instead of staying fixed, instead of the stop loss staying fixed at a particular level, it trails. That is why it trails the market by a set distance. Now, protecting gains while allowing room for growth. All right? When you set it at a distance, depending on your choice, then it moves. Automatically, it moves. When you are in profit, once your setting gets to the way you want it to function, the stop we move, we adjust. And immediately it adjusts, it has already booked profit for you. As the trade is going, it will be adjusting. While the other one, the static one, the regular one, where you put it, that is where it will stay until you manually move it. Remember, I told you guys, one of the way you can manage your trade is you manually move your stop loss into break even or move it into profit. Maybe most people don't know it. It's good. It has its own advantage and it has its own disadvantage. One of the advantage, one of the disadvantage, we have already seen the advantage because it moves automatically and it books profit for you. All right. You still have your take profit, yes, but it prevents price from when you want to reverse, if you're not there, instead of giving that profit back to the market, it will take you out of the trade. It has already booked that one for you. You understand? But the disadvantage is that, there is volatility in the market. Sometimes price will just be going up. Sometimes the volatility, it will come down. That fluctuation will make it come down, but it will still rise again. But because of that trailing stop, once there is volatility, it turns a little back. Once it hits that trailing stop, you are out of the market. But the profit that trailing stop has already banked for you is safe. All right? Okay. Why the other one, the manual one, will remain there until price turn back to come and hit it. All right? Now, step by step on how to use a trailing stop. Now, choose your trailing method. Remember I said it depends on the method you set the trailing stop, and that is the way it will perform. All right? So you can trail by fixed points by pips. For example, you say 50 pips below market price. All right? 50 pips below market price. All right? Then you can say percentage, e.g., 2% below current price. All right? And you can set it by indicator base. That is, e.g., trailing below moving average or ATR, average true rate. That is the ATR. All right? Then there's a tip for volatile asset like SPX 500 or OXY, that is good. The ATR based trade stops adapt better to market swings. All right. Instead of using the market swings, when you're talking about market swings, like a resistance and a support level. But if you're using the ATR based trailing stop, the ATR, that is the volatility of how volatile the market is. It will show you how many tips you are supposed to leave, uh, how many pips gap that you are supposed to leave. All right, that is the ATR. Well, I'm still going to release video on ATR. I think I've treated ATR in my YouTube. Yes, you can go to my YouTube and there's ATR. I've treated the topic ATR, average true rate. All right. In a bullish market, you subtract your ATR from your entry point. All right. You get your stop loss. Then your bearish market, you add it. All right, you add your ATR for you to get where you are supposed to put your stop loss. It measures the volatility. It tells you the number of pips how volatile the market is. It will tell you where to. This is another way you can set your stop loss by using your ATR. All right. ATR differs on different instruments. So if you are trading Euro USD, just say what is the ATR of Euro USD? Type, go to Google and type it to tell you. So you now do your small mathematics. So let's go on. Now the second one is set your initial stop loss. Remember, the first one is choose your trailing method. After you have choose from this method, either fixed point, percentage, or indicator base, most people, most traders like us, we use fixed point per pips. All right? That is what this one simply means at every pips that you choose, once it hits that, it will move. All right? You will understand it now. Then set your initial stop loss. Now, that is the second one. Before price moves in your favor, place a regular stop loss based on your risk tolerance. If you are entering a trade, maybe for example, you enter a trade, from your entry point to your stop loss, maybe if it's 30 pips, okay, set it normal. All right? Set it normal. Then after that, below support for long trades, above resistance for short trade. This will protect you if the trade goes against you from the start. That is the normal stop loss. Now, normally once you, like I told my students, I told anyone that is following me, before you even get involved in the market, your enterprise, you know it. The next thing that will come up is your stop loss. You know where you are supposed to put your stop loss. Now, because we are going to do calculation for you to know the lot size that you are supposed to use based on your capital. All right? So first, you know the entry price, you know where you are going to put your stop loss, how many pips, because each pip has a cost based on the asset you are trading. So you don't just get involved in the market without knowing where you should put your stop loss. As a matter of fact, that is even what will now make you now say, okay, because of the stop loss distance, I will not enter here first. I will wait for it to complete the retracement or let it retrace and get to zero point. All right? Or rather, that will now prompt you and say, okay, no, and I want to use a market order, like a buy stop. The price is here now. I want the price to move up a little. All right, then I can now say, okay, I want to put my stop loss here, but I want to use buy stop. If I'm using buy stop order, that means I'm waiting, anticipating that the price should go up. Okay, so I now set my pending order. And as soon as it starts moving up, all right, then it will activate my entry, then you start going up. All right, so your entry point first, and the thing you need to uh, take into cognizance is that you need to know where your stop loss should be. Then you now start calculation. Your take profit that one is not even the issue. But your entry and your stop loss, very, very key. All right? Then the third one now, after you have set your initial stop loss, all right? Then you now come, the third one is to activate trailing one in profit. All right. You first of all set the normal stop loss order. Then when you have done that, you have already chose the method you are going to use. All right. If it is percentage or in pips, then later you now activate the trailing ones in profit, because that one is different from this one that will now be trailing the movement. All right. As the price is going in your favor, you are making profit. This trailing stop will now be banking your profit for you. All right. Once price moves in your favor, enable the trailing stop manually or via your trading platform. Set the trade distance, e.g., 30 or 40 points. It means that the stop will now follow the price, maintaining the set gap. All right? If you're not saying, okay, the price, once as it's moving, the trailing stop will be following the price as it's moving to the upside. All right, but it will be maintaining the gap. It will always leave 30 pips above. It will leave 30 pips in between. Or if you set it to be 20 pips, it will leave 20 pips in between the current price and your trailing stop. If you set it to be 50 pips, all right, that means the trailing stop will always leave that 50 pips in between the current price and your trailing stop. If you decide to say leave only 5 pips, that means once it starts moving, all right, once it starts moving to your favor, you are making profit, it will leave only 5 pips between the current price and your trailing stop. Now, the challenge there, the problem there is that don't be too greedy, all right? Leave at least a breathing space, all right? Because if it's too close, any little volatility in the market, if it reverse a little, all right, once it hits that trailing stop, you are out of the market. But you are not losing, you have already made some profit, all right? But it is always advisable to leave enough breathing space while you are setting, when you want to set the distance between the current price and your trailing stop. Because as the price is moving to the upside, all right, the trailing stop will always be following it, leaving that set distance. I think it's very clear. So the stop will now follow the price, maintaining the set gap that you'll be the one to set it. Then number 4 is let the trade run. Now, as price rises in a long trade, that means you are bullish, the trading stop moves up. As the price is moving up, the trailing stop will be following it. If price reverses by the trail amount, the stop triggers and closes the trade. Like what I've just told you. Don't be too greedy. Leave enough room for the trade to breathe. Because as it's progressing, as the price is increasing, all right, the trailing stop will also be moving, but maintaining that set amount of pips that you have already programmed. All right. But if it reverses a little, maybe there is a little volatility in the market, once it hits that trailing stop, because that trailing stop has no ability to come down again. Now, anywhere it gets to, it will wait. If the price moves again, it moves. It cannot reverse. That is it. So only the price that can reverse based on volatility. And once price reverses, if it hits the trailing stop, it will take you out of the market. The trade will just close, and your profit that the trailing stop has already backed will be your profit. All right? Sometimes it's painful because if you don't give enough room for the trailing stop, it happens like that. So endeavor to always give a trailing, enough room for the trailing stop. All right, don't be too greedy. Some will just set it and say, don't, once it's 5p, just 5p gap. As it's going, just be following it bomber to bomber so that you'll be booking my profit straight away. But if there's any little volatility in the market, it will just take you out. And maybe it's just a little wave, then it will now start going your direction. You know, be saying, oh, wow, I would have made XYZ amount, but look at it's your choice. All right. So you can also choose manual management. All right. You move your stop, look at it, and place it, leave it there. First, you move it to, like what I've explained, first you move it into break-even. As the price is going up again, you move it into profit. Leave the distance. And let me quickly show you one thing. What most people do, for example, if your, let's say here, this very one, let's remove this. Let's say this very one here is your stop loss. You enter from here. As the trade move to this point, you manually move your stop loss to this point. All right? Let me take it and put this one as green so that you will understand it better. Okay, this green here is your entry point. This one, let me put it red. This red one is your stop loss. Then this one, oh, let's put this one as, let's put this one as blue. Then this one as green for profit. Okay. Now you enter from here. All right, this is your entry point. Then price now start moving. All right. Because even if it moves, your entry point still remain the same price you enter. It does not change. You'll be making profit. All right. You'll be making profit. Let's say you are making profit and the price got to this point. This still your stop loss. Now that the price has already broken this, what do you call it? It has broken this break of structure, then you know that it's going to pull back a little. All you need to do is move your stop loss into break even. You move your stop loss from here to your entry price. Now, even if price now decide to, is here now decide to come back and take you out, you are not losing anything. All right? You are not losing anything. It's just going to be break even. All right? You are not gaining anything. You did not gain anything from that trade, and you did not lose anything from the trade. So now that your stop loss is here, and now this is, you have made a little profit, and your price, the price of the price is now here. After this pullback, price now start moving again. Once you get to this point, all you need to do, you just carry this and then put it here. All right? Once you move again like this to this point, you just take uh your stop loss, move it, and you can put it here or you can put it. You understand the flow. You move it to, as it's going, if it gets to a resistance level, you adjust your stop loss, put it at the previous support level. All right? To be on safe side, you carry it and put it here. All right? So it's like this. As it's going, you are adjusting this manual. Or if you don't want to do that, or if you're not doing that, what you will do next is once price move from here, this entry, as it's going, it gets to this level. If your lot size is, let's say, one lot size that you use when you enter this trade, or maybe it's two lot size, as the case may be, depends on your risk tolerance, then you take partial. Taking partial simply means you reducing your lot size. Let's use one lot as an example. One lot, you now reduce it to 0.5, all right, instead of one lot. Once you reduce it to 0.5, that means because it's a bullish market, you have now sold half of the asset, keeping the other asset to continue running. So you have already banked some profit there. Now that you have banked some profit, you can now move your stop loss into break even. If you like, let the price come back and hit this place, you have already banked some profit. Otherwise, you can go and sleep because you have already reduced your stop loss, your lot size, and also you have already moved your stop loss into break even. All right. So you are not risking anything and while the trade is running. So you can just go and sleep and allow the trade to continue to run. So that is how you can manually do it. All right. Then the fifth one is adjust based on volatility. Now, tight trail, that is quick exit. Less room for pullback because if the number of pips, the distance you set is too close, if there's any little volatility, like I said, it will push you out. If the price is making a pullback, just a little pullback, minor pullback, it will push you out of the market. All right, so be fair enough to leave a reasonable distance. All right, I think you understand what I'm trying to say. Loose trade, more breathing room, but may give back more profit. It may give back more profit, meaning that, okay, if you give a little more room for the trade to breathe, if peradventure the trade reverses and later come to hit your trail stop, the distance you give, all right, meaning that distance you have lost the profit. If you give a tighter distance, a little distance, that means you've saved enough profit. But by and large, it's always good for us as a trader to give room, knowing fully well that there is what we call volatility in the market. All right. And one of the tips I want to give is use weather trades during news event or high volatility. Use weather trade, all right? Now, example, I just use the SPX 500, that is long trade, for example. This is just example for us to be clear about what we'll be saying. Let's say your entry your entry is 4,500. Now, your initial stop, that is the stop loss that you need to just put normal your entry, your stop loss, you understand? Where you put your stop loss is 4,470. That means you are giving what? A stop loss pips of what? 30 pips, right? 30 pips. Hmm? Okay. Now the trailing distance is 30 points. When you now activate it, you know that the trailing distance is 30 points. All right. Price moves to 4,540. Stop moves to 4,510. Do you understand? So that means as it's moving, it will move, but it will always give a space of 30 points, or rather 30 pips. If it moves, the stop will move, but it will maintain that 30 pips. All right? Or if the distance you gave based on your setting is 20 pips, as the price is increasing, the stop will move, but it will maintain that 20 pips. That means the 20 pips is in between that entry where the current price is and where the trailing stop is at that moment. So that is the analysis I'm giving. Price drop to 4,510, trade closes, locking in 10 pips profit. Do you understand? So you get the whole story here now. So it's a very simple thing, guys. So this is the end of this episode. And I want you guys to understand one thing, that trailing, this is the next, we are going to talk about psychology, very important. The next topic, guys, you guys should prepare psychology, because that is very important. So you guys should understand that trade management is very, very important and is key. Not just placing your trade and just leaving it. Some people do that, okay. I'm not against it. That is what we call set and forget. You just enter, you have done your analysis, everything, you place your trade, you just close your system and you go and sleep. The only thing you'll be waiting for is once in a while you check whether you are in profit or you are making loss. All right? And you don't want to do anything, you don't want to apply what we call trade management. And as far as I'm concerned, it's very, very important. All right? Because once you get into the market after your analysis and all that, and the trade moves in your favor, you can manually move your stop loss into break even. At that point, you are not risking anything again. If you like, let the price come back, let the price reverse and come and hit your stop loss. That is break even. You did not lose anything and you did not gain anything. That is break even. All right. And another thing is, once you are making profit, manually you can move your stop loss into profit, or you use a trailing stop. All right. Or you move as it's going up, you move your trade to between support level. We move from here to here. As it's going again, you move again like this. You are moving it from here to here from here to here, here to this point as it's going up. Can you imagine this whole move like this? All right. You are moving your stop, you move it and you get here. Why the price is going. Once you move, you know that the price has gotten to, you move it to the next support level. You can manually do that. If you don't want to do that, the next one, the option that is available on how to manage your trade is for you to activate the trading stop. Activate that, set the options. Pips give enough room. As the trade is going, the trailing will just be following it, keeping or maintaining that same point which you have set. On this note, I say thank you so much, guys. Please, I want you to leave a comment. All right, if you are getting value from this course that I'm giving for free, today is the 27th, if I'm not mistaken, 27, oh no, 25 of September, all right, 2025. And we started this thing even before on the 1st of September. I've been dropping videos, materials that I know you need. The basics. Now, if you have been watching my video from the beginning up till now, and you have not started demo trading, that means you don't know what you are doing. Pardon me, sorry about that, but that is the truth. Because even if you pack your bags and everything, go to a hall to go and attend a seminar or go and pay $2,000, $1,500 for this course, you will not get the same value that I'm offering for free now. I'm telling you, you go there, you come back, you discover that trading is all about getting the basics, the foundation. Then you will now go back home on your own and now start digging it out yourself, trying to figure it out yourself. That is trading. When you learn, you have to practice. And that is why there is demo account. That demo account, your money is not there. So use that money wisely. Use it in a way, all right, like it's a personal account that your capital is involved. All right, there you know how to manage your risk. You know how to, I've already dropped video on that. You know how to say, okay, I have this is my capital. All right, okay. I want to, at every trade, I will not risk more than this. You should know your risk per trade. You should know the number of your pips based on your stop loss and your entry point. Those things, once you're able to find out all those things, you're able to perform your top-down analysis very well. You know what market structure is all about that I've already treated, showed you people. All right? Before we round up, I'm still going to do one more video on market structure because you need that. You need it. Some things you cannot shy away from as a forex trader. Market structure. Knowing market structure, because once you know market structure, you open your chart, you should be able to say, without even marking anything, you should know the direction. Oh, how do you know the direction? Go to the higher time frame. Open the higher time frame. From there, you know the direction of the trend. If it is bullish, you will know immediately. If it is bullish, you will see price breaking structure to the upside. I've already taught you people break of structure. All right? And once it's bullish, the target will always be buy side liquidity. Price will go up, break structure to the upside. Once it breaks structure, it has already taken a buy side liquidity. Then the next thing, once it hit a resistance level, hitting a resistance level meaning that it has given us the highest price. Now the pullback phase, as it's coming back, it will now stop. Once it stops, that means he has already hit what we call support level. He has created support. And the support level, sellers and buyers are there. Resistance level, sellers are there. So the support level, buyers will now start offloading their orders. They will now push the price up. All right? They will not push the price up. As the price is going up, the next target again is that buy side liquidity. Anytime you see price, instead of price to follow order flow, what do we mean by order flow? As you are on a trend that is up, it's supposed to break structure to the upside and give you a higher price than the previous high. So anytime you now see price gets to that same level of price and it did not break it, that means it failed to create another high. Watch out. It's going to turn and give you what? As it's coming back, all right, instead of that price not to break the support level because it's on a higher, because it's bullish, it will now break the support level. Once it violates the support level, that means the sell side liquidity has been tapped, has been taken. That is what we call market shift or change of character. It is a trend that is bullish, that has no business, all right, has no business violating the support level. And a trend that is bearish has no business violating the resistance level. Anytime there is violation of resistance level on a bearish trend, just know that the buy side liquidity has been tapped, has been taken. That means that is violation. Then the price at that point will say market shift, meaning that a bearish trend will now change to become a bullish trend. The same thing, a bullish trend, once it fails to take this buy side liquidity, it now turns to take the sell side liquidity. All right? Once there's violation of that support level, it then means that that is what we call market shift or change of character. It then means that a bullish trend has changed to now become a bearish trend. So thank you guys. The way I'm explaining to you guys, I want it to sink. I want it to sink. That is why I'm explaining everything every time for you guys to understand. So on this note, I see you again in the next episode. Continue striving until you are able to find your feet. God bless you.